All right, we are going to look at a couple of problems here, four problems here in part one, and that you could see something similar to what you could see on the exam this coming weekend. Um, so let's go over this first one, and I will email these out to you so you'll have a copy of it to look at. On January 1st, 2019, Precision Pumps leases non-specialized pumping equipment to Mega Construction. The equipment is delivered on January 1st. The lease term is for 6 years with no renewal or purchase options, and title to the lease is retained by the lessor at the end of the lease term. The lease requires annual fixed rental payments of $7,000 per year, beginning on January 1st, 2019, and January 1st of each year. The fair value of the equipment is $37,592 and has a carrying amount on Precision's books of $22,000. The equipment has a remaining life of 8 years. The rate implicit in the lease is 6%. There are no prepaid rentals, and neither party to the agreement pays initial indirect costs. Make the journal entries for Mega in 2019. All right, so let's go through our criteria here to determine whether this is a operating lease or a capital lease. So criteria number one, does title transfer? No, it does not. We are explicitly told title does not transfer. Number two, is there a bargain purchase option? And we are specifically told there is no renewal or purchase option. So no on number two. Number three, do we have 75% or more of the economic life of the asset? Provided it's not in the last 25% of its life. And so the lease term is for 6 years. We're told the life of the asset is 8 years. And so number three is a yes. And so right there we can say it is a capital lease. We'll go ahead with number four just to identify it. And so the fair value of the equipment is $37,592. We have an implicit lease rate of 6% and $7,000 a year payments. So we have $7,000, and we look at our time value of money tables, present value of an annuity due, and that is going to be for 6% for 6 years, and that is 5.21236. And when we multiply that out, $7,000 times 5.21236, we get 36,486. We're going to divide that by the 37,592. And that's going to be 0.97 or 97%. So number four is a yes also. And then number five, the beginning sentence says Precision Pumps leases non-specialized pumping equipment. So number five is no. Now remember, we only needed one of these. We had two. And so this is a capital lease. So that's the first part. The second part is it is a capital lease. Then we have to determine if it is a sales or a financing lease. Well, actually, we don't here because we're doing the journal entries for Mega. If we were doing the journal entries for Precision Pumps, we would have to. And I'll show you that in just a minute. But in this one, the journal entry is going to be, so we're going to have a right of use asset. So 1/1 of year one is a right of use asset. And that will be for the amount that we determined here, the 36,486. And we will have a lease liability for 36,486. All right. Then we also have to have that first payment. And so we're going to write off the lease liability. And that is $7,000. And we are paying cash for $7,000. All right, now some people occasionally will collapse this and just do the lease liability for would be 29,486, and so I have right of use asset 36,486, lease liability 29,486, and cash of $7,000. That's okay when you're signing the lease on the day that you're actually taking possession. But if you're signing it at another time, it's probably not the best. All right, so then we get down to 12/31 of year one, and we need to make our adjusting entries now. And so the first adjusting entry we're going to have is interest expense. And that's going to be the 36,486 minus the 7,000. Which will be the 29,486 times the implicit rate of 0.06 or 6%. And that will be 1,769. And then we will have interest payable. $1,760. I wrote 2. I said 9. Said it right, wrote it wrong. 1,769. All right. But we also have, remember, the idea behind a capital lease is that we are purchasing it. And so we are going to have the depreciation expense here. And so the depreciation expense, always assume straight line if you're not told anything else. And so we're going to take the 36,486 and we'll divide that by 6 years. And that will give us 6,081 and accumulated depreciation 6,081. Now, okay, so I mentioned that is it a sales type lease or is it a finance lease? So let's go back up here to the thing, and we see that the fair value of the asset is 37,592, but it's on our books for 22. That makes this a sales type lease as opposed to a finance type lease. And so our entry, if we were, and the problem here only asks for mega, but if we were to do the first entry for precision pumps, it would look like this. So just something slightly different. And we would have lease receivable, and that would be, assuming the same interest rate, would be for the 36,486. And we would have lease revenue, 36,486. But we also are going to have cost of goods sold, and that will be for the what it says up here, the $22,000. And we will take that out of inventory. $22,000. All right, so this indicates that we built these pumps ourselves, and so we're making a profit on the manufacturing as well as on the leasing. Then the interest, go down here to 1231. The interest would be interest receivable, and that would be the 1769, and interest revenue 1769. All right, so that's a little extra on this problem. Okay, let's move on to the second problem on this particular exam. All right, so Northern Equipment leases cooling towers to Warm Up Corporation for $23,080 a year. The equipment is not specialized and is delivered on January 1st of 2019. Fair value of the equipment is $180,000. The cost of the equipment to Northern is $140,000. All right, so right now you're thinking this will be a sale type lease if it is a capital lease. The expected life of the testing equipment is we went from cooling towers to testing equipment, is 8 years. The lease term for the equipment is 8 years, with the first payment due upon delivery and 7 subsequent annual payments. Northern's implicit rate is 8%. Make the journal entries for Northern Equipment. All right, so this time we're doing the other side of the coin. We're doing the lessor, not the lessee, first. And so we're going to have now we can go through the whole thing. Well, we really don't know much about, is there a bargain purchase option? We would assume no if it doesn't say so. And there's nothing to tell us that title transfers, but the expected life of the equipment is 8 years, and the lease term is 8 years. So we know automatically this is a capital lease, right? So we've got 100% of the useful life of this asset. So our entry is going to be lease receivable. Remember, we're doing the lessor side first. And the lease receivable will be for the present value of the $23,080 at 8% for 8 years. And if we look on our table, present value of annuity due, 8%, 8 years, that is 6.20637. Come over here to the side. So we've got 23,080 times 6.20637. And when we multiply that out, we get 144,000. We get 144,566. Now, this may not be a sale so much. There's only about 4,000 difference there on that one. But we're going to go ahead and treat it like it's a sale lease here. So we've got the lease receivable, and then we will have lease revenue. Then we will have cost of goods sold, 140,000, and inventory. All right. And then at the end of the year, we also have the cash that comes in. So we're going to get cash of 23,080, and that will come off the lease receivable. 23,080. Then on 12/31, remember we will have to do the interest, and so that's going to be the 144,566 minus 23,080 gives us 121,486 times 0.08, which is our implicit rate, gives us 9,719. So our interest receivable is going to be 9,719, and this will be interest revenue, 9,719. All right, so that is Northern Equipment. Let's go ahead and move on to number 3. All right, so this is kind of a long problem. This is one of those tax on the financial statement problems. Okay, so Gustav Inc. uses the accrual basis. And actually, I've got the answer here for you already. Gustav Inc. uses the accrual basis to account for all sales transaction. Sales for 2018 total $500,000. Included in this amount is $75,000 in receivables from sales on installment. Installment sales are considered revenue for book purposes, but not tax basis of the installment sales receivable. So the book basis is going to be the $75,000, right? So we are recognizing the income, and so the basis is the $75,000. It says, what is the tax basis of the installment sale receivable? Well, that would be 0 because we have not recognized any income on that yet. So the tax basis is 0. And then C, assuming a 30% tax rate, compute the income tax expense and deferred tax provision and income tax payable for 2018. All right, so I'm going to slide down here. We have 500,000 minus 150,000 of expenses. That's going to give us 350,000 for book purposes. And we're going to multiply that times 30%. So 350,000 times 0.3 is 105,000. So the income tax expense is 105,000. Okay, the deferred tax provision is going to be the 75,000 times 0.3. And that's going to be 22,500. And that will be a deferred tax liability because we are recognizing more on our books than we are on our tax income. And that's 22,500. And then our income tax payable will be the 500,000 minus 75,000. That's the difference. That's a temporary difference. That's going to give us 425,000 minus the 150,000 expenses that are the same. So that will be 275,000 times 0.3. And that will be 82,500. And so our income tax payable is 82.5. And you can see if we add 82.5 to 22.5, we get 105 for the tax expense. And then 5, prepare the journal entry to record the income tax expense. All right, so I'm going to slide this down here a little bit. The journal entry would be tax expense 105, income tax payable 82,500, and deferred tax liability will be 22,500 on that. All right, so this one's also worked out for you in the email I sent you. So, you'll have that. All right, the last problem. We have the Garza Corp has a deferred tax asset from a higher tax depreciation than book depreciation. In 2017, the tax rate in 2017 was 35. The value of the deferred tax asset is 50,000. Garza expects a temporary difference to reverse at a rate of $10,000 a year. Late in 2018, the government changed the statutory rate from 35% to 25%, make the journal entry effective for the rate change for the statutory rate. So we have the easiest way to do this is to say 50,000 and then divide it by the tax rate, which was 0.35. So that means that deferred tax asset was based on a book tax difference of $378,571. We now multiply that times 0.25. That is our new tax. I must have did something wrong on the first one. So let's take the 50,000 and divide that by 0.35. Okay, that was the wrong answer then. Okay, so 50,000, somehow I hit something wrong in my calculator, divided by 0.35, and that's going to equal 142,857. Okay, so now that's the income. And then we multiply that times 0.25. And that's going to be 35,000 714. Okay, so now we need the difference between 50,000 and 37,000, 35,000, 714. And so that difference is 14,286. All right. So now our journal entry is going to be tax expense 14,286, and that will be, we write off the deferred tax asset 14,286. All right, so that takes care of that one. All right, so that is part one of the review. I'll go find another test and put up part two for you.